We're starting to see a phenomenon within the economy that wasn't anticipated. A lot of listings had been coming into real estate inventories, but in Florida, a process has begun where a significant number of listings are being pulled from the market, and this has been happening for various reasons. Let's take a look at what might be behind all of this and why inventories haven't continued to increase. Because what many real estate agents were speculating, at least, was that inventory was going to rise a lot and that prices would indeed drop. We've never believed that was going to happen, because inventories needed to reach natural and normal levels, but prices were very likely not going to be affected due to other factors. But for sellers to pull their listings without having sold them is a phenomenon you don't usually see in the real estate economy. Let's analyze in detail what's happening. Additionally, let's take a look at delinquency. Many properties, or rather, many people, are falling behind on their payments. This is really important. It's going to affect the market in the future. Are we going to see a wave of foreclosures, or is this simply a phenomenon of readjustment after the price increases and everything that's happened over the last 5 years? We're going to analyze rents, and we'll look at the importance of rental inventory with an example that happened in New York. Don't miss it, because this experiment in a small city of 85,000 inhabitants is super interesting. It has set the standard when it comes to rentals, and you can check out what's happening right along with us. As always, we're going to analyze this with complete transparency and honesty, just like the top real estate agents and number analysts in Florida who can help you buy, sell, or rent. But most importantly, they know the market in detail so that together we can make decisions with the most information possible, which means these are the smartest decisions we can make. As always, myself, Gabriel Peroso, I'm here with my friend and business partner,
Molina. It's a great pleasure to be with you all today.
There's something interesting, Jenny. You, as CEO of Engiard in Miami Real Estate, as that operations agent, that chief operating officer leading the real estate agents, leading the lenders. Why do you think something like what we called a dislisting is happening?
Look, there's a very particular situation, and we have to remember that real estate in the United States in general, and especially in Miami, has a lot of equity. If a person or a seller puts their property on the market at a certain price, and I can't find a buyer who agrees with that price, they have two options. Lower the price. That's one. 2, simply take it off the market. Those who lower the price usually do so because they have some need, maybe they need to move, or for some reason a life change requires them to sell the home. But there are many people who don't have that need and simply decide to withdraw the unit from the market, rent it out, or just keep living in it. This is what's happening nowadays. This is something that, at the level it's happening, we haven't seen before. But I have an article here from Realtor.com that talks about the numbers, about what's actually going on. The headline reads, "Stubborn home sellers in Miami are pulling their homes off the market at a higher rate than anywhere else." Here's why. And first I want to scroll down here in the article because I want to show you what's happening at the national level. In June, the withdrawal rate, you could say, reached 0.21, which means that for every 100 newly listed homes, 21 previously listed homes were taken off the market, and that's the national average. But here in Miami, we had the highest rate. And with what number? 59. That is more than double the national average. This is what's happening in Miami. Phoenix comes next, ranking second, with 37 homes withdrawn for every 100 that are listed. It says, nationwide, property withdrawals increased by 48% compared to the previous year. Basically, this increased by 50% nationwide, this new trend, and it has a lot to do with what you mentioned in the previous podcast, Gabriel. Sellers also think they're going to have a better buyer's market when interest rates go down. So they probably take them off the market to wait until the end of the year when interest rates go down, to try to find a buyer who will pay the property's value. We always say that the sale price is where the buyer and the seller meet. And that's not happening in Miami. In many of the units, they're simply taking them off the market. And how should we say it? It's a new trend.
Yes, it's a new trend, Jenny. There's something important in all of this. The seller is seeing that none of the narratives are in their favor. At no point right now does the seller feel motivated to sell. Everyone says, it's a buyer's market, it's a market with excess inventory, it's a market with falling prices, and if I see that everything is against me, why sell unless it's out of necessity? But otherwise, why go out and sell? I should go out and list, but not go out and sell, which is very different. That's when you say, I go out, I think my house is worth 600, I list it at 600, and if something happens, great. If nothing happens, I just leave it there for a while to see what happens, to test the market, to see if offers come in, if I show it, if today they negotiate with me, how many of those offers are really low, and I don't feel pressured to do it. The day I get good news in my favor, I'm going to feel much better and I'll want to sell. If I'm an investor who has my house rented out and I'm at a point where I say, I want to cash out the equity or the appreciation I've gained, because my property has already been in my portfolio for 8 years and I want to refresh it, I'm going to put it up for sale when the market is in my favor. I mean, there's no reason for me to rush to do it. This is a phenomenon that happens, and it's the same kind of phenomenon as, I'm going to get into the market because I don't want to miss out on what's happening, like what happened to us 2 or 3 years ago when interest rates dropped and all the buyers jumped in, because everyone was buying. I have to buy, I don't want to miss out. The opposite happens with the seller. When everyone is saying it's going to hurt me, I say, yeah, everyone says it's going to hurt me. So even if it doesn't, it's going to hurt me. I'd rather get out, because if I'm the one getting hurt, then that's what's happening. I think it's a natural phenomenon. The important thing is that we have a way out. We're just months away from that way out.
Exactly. Additionally, I wanted to add that the discourse on social media is that there's a crash and that there's going to be a crash, that there's no solution in the real estate market. Probably these sellers, as a result of this media rhetoric, realize that they're caught in a bubble where all they get are lowball offers because the internet says the market is collapsing, which isn't actually happening. And so they simply decide to pull their listings, decide to take them off the market, and wait for things to get better next year or by the end of this year.
That's right. That's my analysis.
Yes, I know you're currently in arrears because those who keep the units on the market probably have some problem, and one of them is arrears.
Yes, Jenny, although if you only knew, there's so much capital gain in all the properties that you don't see a significant amount of delinquency. However, let's review. Foreclosures remain low, but FHA loans in the Southeast, basically states like Mississippi, Louisiana, Florida, Georgia, are in the yellow zone. Let's see what they mean when they say they're in the yellow zone. The first thing we need to look at is how housing foreclosures are doing for the second quarter. Here we're looking at the second quarters since 2014. Here we can see what the levels were in 2014, 115,000, and we can see today's levels, 52,000. So we're no longer talking about the 2008 bubble here. We're talking about a normal market now. Here we can see how there were 94,000, 82,000, 84, 65. In 2019, we were at 66,000 in foreclosures. Now we're seeing that it's 52,000. So we're still below pre-pandemic levels, still well below the levels of 2014. Nothing to worry about, nothing that's increasing. This is just normal economic movement. What's happening here? However, here we can see in the graph how it's working. I think I have it better here in the interactive version with a black background. Here it shows us exactly that. We can see the foreclosures up to the second quarter of 2025. As shown in the graph, we can see what happened during the 2008 crisis. We were talking about around 600,000 foreclosures. Here, we're at very low levels. In 2021, they were almost unnoticeable. When we were talking earlier, people were saying a crash is coming. Anyone who reads this chart says, there's no crash coming. They say, no, but this is going to go up. Look, it has even gone down already. What's going on? There's a lot of equity here. I mean, you sell in a short sale and you're good. Back then, there were a lot of factors, including loans given to people who couldn't pay, at prices that were way too high. Here, all the loans were given to people who actually can pay, at prices that, even if people think they're high, are just the normal market prices. Here, the prices were inflated, because of course, the price was inflated, like if in 2008 they told you 250,000 and the bank lent you 250,000, but if they told you 350,000 and the bank lent you 350,000, the prices were inflated by a market that didn't really exist. Subprime bank loans, basically, poorly given, poorly qualified loans, and that caused a domino or staircase effect throughout all of this. That's not happening now. Here we can see that the foreclosure market is pretty well controlled. Next, we see the percentage of mortgage balances that are over 90 days past due. We can see that by 2025, we're at 0.8. Before the pandemic, we were at levels of 0.9, 1.1, 1.5, 1.8. In other words, these aren't foreclosures yet, but rather mortgage balances that are 90 days delinquent, those with a significant delay in their payments. It's still not very high, and we'll even break it down further. Here we can see it broken down depending on the person's credit, that is, depending on the type of credit. We see that credit cards are about 12% delinquent at 90 days. We see student loans, Jenny, which had basically disappeared from the map until January of this year, when collections on these loans started up again. Remember, they had been on pause. With the arrival of the Trump administration, they started collecting on them again. Student loans have now become a significant part of this delinquency. Auto loans have started to go up a bit, and we're seeing HELOCs and mortgages, which basically brings us to the housing sector, at very manageable levels, below 1%. Obviously, these are the most expensive portfolios among all types of credit. They're the ones with the strictest requirements to be granted, and this proves it. Then, if we keep looking here, talking about 30 days, that is, if the difficulty is increasing, yes, it is going up, Jenny, but not to overly complicated levels. We can see that up until 2014, 2015, we were at 4%. Yes, it worries us that now we're at 3.7, while in 2019 we were at 3.4. What does that mean? If we're already above the 2019 level in terms of 30 days, it could mean that in the last 30 days, people have had a bit more trouble with their personal finances. We're seeing it with a rise in unemployment. We're seeing it with a very slight uptick of 0.2 in inflation. It could be that tough times are coming. We know that the start of the Donald Trump administration has brought challenges to the economy. It seems like everything is stabilizing with issues like tariffs and the Fed's interest rate cuts. And that's why President Donald Trump says that interest rates should be lowered as soon as possible to step on the gas for the economy and prevent families from facing recession hardships. Here we see it in the 30-day delinquency rate, just like we saw earlier with credit cards going up. Here we see student loans going up. In other words, what's becoming most problematic is the repayment of mortgage loans and, well, student loans too, which could also be due to financial adjustments. It's very common for a family not to have planned for a $300, $350, or $400 student loan payment for 4 years, and then when it's reactivated, they have to readjust their finances to be able to manage and pay this. Here we see that 30-day mortgages have also increased significantly. We're talking about 4%, but as we always say, the challenge is going from 30 days, Jenny, to 90 days, as you can see here, and that's also related to the amount of equity people have. We have a couple of people who are selling because they're having trouble paying the bank, and honestly, the bank isn't even putting any pressure on them. The bank knows that when someone has $300,000, $400,000 in equity and the property is listed, why would I put on any pressure? Why would I waste time trying to collect, hiring a lawyer, if you're already doing the work and you're going to pay me back what you owe without any trouble? As a bank, I don't need to start a foreclosure process if you're only about 60 days behind. I'm going to give you some leeway to work things out as long as you show you're making an effort. What's interesting here, Jenny, is that in the transition of more than 30 days, it's the FHA loans that are leading the way. And obviously, FHA loans are given with slightly more relaxed standards because they're loans backed by the government and they have somewhat easier conditions to qualify, which means they can indeed be the loans that generate the most delinquencies. It's interesting to see that veteran loans have increased, but they're still at pretty low levels. The loans they call other, which most likely include all the jumbo loans, loans for larger properties, or loans granted under different conditions. and conventional loans are holding up very well, the conventional ones. That is, private banks are issuing loans very well because that's where the lowest delinquency exists. The concern with FHA, Jenny, is that if we look at it over 30 days, it's above 4%, and this could be problematic because if we look at the distribution, as shown in the chart made by the Federal Reserve of New York, if we look at the distribution, FHA loans might be the ones representing the highest delinquency in the entire overdue portfolio right now at 30 days. That burden, let's say, of it having been rising, however, it doesn't keep going up. We can see that in the end, it's a downward trend. All that burden we're seeing right now is falling on the southern part of the country. 16% of FHA loans in Florida, 16% are FHA, and in Texas, Louisiana, Mississippi it's 21, 22, and in Georgia it's 17. We can see that this whole area is heavily affected because the burden is greater with FHA. There are more FHA loans in that region. What happens if this delinquency keeps increasing? We're going to see more foreclosures in this area. But it's all speculative, because we see that the levels are still so low that we can't really think this is going to have an impact yet. There's something interesting to mention here, Jenny, as a side note, which is that President Trump has already announced that FHA loans, which are basically backed by the government and Freddie Mac and Fannie Mae, well, Fannie Mae and Freddie Mac are behind them. Freddie Mac and Fannie Mae are going to go public on the New York Stock Exchange very soon. The president wants it to happen as soon as the end of this year. In other words, they're going to become public companies. We need to see how the whole issue of guarantees for these loans will turn out for borrowers, because it could also affect the New York Stock Exchange in the future if foreclosures start happening and these companies are publicly traded. It's something that's coming and is still developing.
Interesting.
Let's continue, Jenny.
Yes, I have the outlook for you. Above all, I want to draw attention to the areas in Florida that the people at Totality, which used to be CoreLogic, are keeping an eye on, that they have on their watch list. And I want to bring you a report from them from August 2025 where they talk about, I've brought the map for you. The areas where prices are going up, look, here you have everything in the northeast of the United States, from 12% in a city in West Virginia to 9.5% also in Wisconsin. So really, in this area, there's a significant increase in prices and low inventory. Where price is going down. Look, in Florida, we have quite a few. We have Norpol at minus 5.3. We have Napole at minus 4.7. Here on the list, I see that Core at minus 7.4 is leading the list. And in addition to this, they always highlight the area based on the increase, being how much inventory is coming in, how long it takes for units to sell, and what potential problems we might face in the future. We have 5 areas in Florida. Honestly, for many years, I hadn't seen all 5 areas in the same state where, let's say, they all had a downward trend in home prices at the same time. Now we have them in Florida. If acquiring property in these specific areas is a viable option, you absolutely have to keep in mind that current market prices are indeed going down significantly. And if you have units for sale in these areas, you need to be very strategic when putting them on the market in order to actually sell them. So really, those are the price trends I want you to pay attention to. These are the 5 cities in the state of Florida where prices are going down and where you really need to keep an eye out whether you're selling or buying. Tavi, I know you have an example of rentals. Now that gives us an idea of what we should do to improve the...
Look, Jenny, this is super interesting. The Wall Street Journal brought this up this week, and I loved it because it's about how a New York suburb is managing to lower rents. This really challenges that idea we always have here, that prices have to go down just because they went up. No, folks, prices don't go down just because they went up. Prices go down because there are factors pushing them down. A simple price increase isn't a factor. A simple price increase is just the natural result of other factors that made them go up. So what happened? This is a city called New Rochelle. It's a city that's 40 minutes from Midtown Manhattan by train. It's a suburb with only 85,000 residents. So what do they do to make rents go down? It says, New Rochelle has completed more than 4,500 new homes in the last decade. Another 6,500 are under construction or in the planning phase for the coming years. These 11,000 new units would represent a 37% increase in the number of apartments in New Rochelle compared to 10 years ago. I want you to notice an interesting ratio here. 85,000 residents, 11,000 new homes. In other words, we're talking about there being at least 15% more homes than residents, right? That ratio is surprising. And what effect does that have? It says the average rents in New Rochelle are only 1.6% higher than in 2020, which is way below the increases of 25% or more in New York City and outer markets like Newark, Hoboken, Jersey City, New Jersey, or what's listed on Apartment List. What's going on? There's a very interesting phenomenon here. It's the inventory that keeps rental prices from going up. The inventory is what keeps home sale prices from rising. So, what's the natural argument anyone would make here? Builders aren't going to build if they know they're going to lose money. Why would I build if rents only went up by 1.6%? The builders are going to do it. It turns out this city focused on something very, very simple. They say, city officials claim they relied on a policy framework that encourages residential construction, streamlined environmental assessments, offered tax incentives to real estate developers, and created standardized zoning regulations to make housing construction easier and cheaper. They assure that a permit is approved within 90 days. Take a look at the difference between the increase in national rents and the increase in rents in that city. What does this mean? That if you give the builder the right scenario, you tell them, you won't pay so many taxes, I'll approve everything quickly, you'll have a single, easy, straightforward zoning that you'll understand. The developer builds. Why? Because they'd rather build quickly, maybe finish a building in a year and a half, 2 years, rent it out, and move on, than be stuck in Miami-Dade fighting with the city for 2 or 3 years just to get the permits, then have to start construction, then have to deal with issues during construction, then face problems when it comes to formalizing or completing the project, and then renting it out is a whole other ordeal. It just gets way too complicated. If I have a city that helps me get everything done, the builder will go ahead and do it, even if they make less money. But what happens then? When you spend 5 years in the process, you want to make a lot of money, but if it only takes 2 years, it doesn't matter if you make less, because you earn a little, and that little bit adds up, and in the end, you end up making a lot of money. This is where all that talk about how what we really need is for prices to just go down gets debunked. No, prices go down because there's something called inventory, which causes prices to drop and ultimately benefits families. Jenny, that's exactly where we're headed. How are rents doing? Are they helping or not helping in Florida?
Look, one of the big advantages Florida has is that it's a state that favors or protects property owners. What do I mean by that? If you already own a property, or if you're going to buy one, you want to make sure that in the future, whether it's tomorrow or later on, when you decide to buy a new one, or if you want to invest and buy a property to rent out, you want the laws to protect you. And what does it mean for the law to protect you? Number one, that the eviction process isn't bogged down by bureaucracy and can be carried out quickly. Number two, that property and rental taxes in your state work in your favor. Number three, that there are no rent control restrictions, that there's no kind of rent control, that there's good rental demand, that the entry cost is affordable, and that the area, that is viable for remote workers. Based on these characteristics, there was a study where they wanted to determine which states in the United States are most favorable for landlords, for property owners who decide to rent them out. And here we have the top 10. At number 10 is Colorado. Number 9 is Kentucky. Number 8 is Ohio. Number 7 is North Carolina. Number 6 is Georgia. 5 is Alabama. 4 is Indiana. 3 is Arizona. And here in Florida, we're number 2. Reasons. Even though taxes can't be avoided, really in the state of Florida, there is no income tax. The property tax, although the article says it's 0.84, it actually depends on the city where you have your property. We know there are cities or counties where it's 1.5, 1.6, and in others it's much lower. On average, it's 0.84. And the operating costs stay low and manageable. Florida doesn't beat around the bush. When tenants don't pay rent, the eviction process is straightforward. You give the tenant a 3-day notice, and then the eviction in court takes a couple of weeks. There's no rent control, and a lot of people will ask, what is rent control? There are states like California or New York where you can, in many properties, you can only increase the rent by a maximum percentage per year. In Florida, there is no such rent control. Additionally, housing prices in many areas, you can still find homes that are affordable and make good investments. Every week, we identify units in the city of Miami and its surroundings that are good deals for investors, putting down 30% as a down payment with a rent. They basically pay for themselves, and you keep your unit rented out, allowing its value to appreciate over time. So that's the situation in Florida. It protects the investor and also the person who wants to put a unit on the market in hopes of finding a good tenant. The only state that beats it is Texas, and in my opinion, it wins because the units there are much more affordable. But, well, we know that when it comes to long-term appreciation, if we take that factor into account, Florida beats Texas. Now, I know that rental prices depend a lot on migration, and I know that you, Gabriel, have information about migration.
Yes, Jenny, there are new numbers out about international migration, and the impact that the Trump administration has had on migration has been huge. Areas that may have been affected, Florida. That's exactly what I want to look at from Florida's perspective, since that's the topic of this podcast. And here we can see international immigration increased after the pandemic, but now it's going down. This is what it means for housing. The American Enterprise Institute, which is what these initials here stand for, released some predictions. They're pretty broad predictions, but they're definitive compared to what we've seen historically. We're seeing that their predictions range from over 115,000 people to less, minus 525,000. What does this mean? Here we can see the range. We can see how immigration has been in the United States since 2001. We're seeing an average of 1 million people. It dropped a bit during the Trump administration, but look at the craziness this turned into during the Biden administration. Part of this is what led to Donald Trump becoming president, because I think these are levels that aren't healthy for an economy where you could have 1.7 million, 1.3 million, 2.3 million, 2.8 million people coming in without being classified, because in the end, people were coming in who aren't necessarily contributing to the economy, simply as part of an open borders policy that, okay, encouraged a labor force, but you don't really know what kind of labor force is actually coming in. I think this can be done in a better way. Obviously, Donald Trump comes in, and this is what the Institute, the American Enterprise Institute, is predicting, that it could be 115,000 or it could be minus 525,000, because they're taking into account all the deportations. In other words, it could actually be negative depending on voluntary and forced deportations that Donald Trump might carry out, which would reduce the population by 525,000. When we look at this, whether it's healthy or not for the economy, this chart shows us. Here we can see what the annual net population growth was like from the year 2000 up to today. Between the blue line, you'll see that's the natural growth, basically births. And when we look at the net international migration, that's all the gray area. Notice how births have always outnumbered migration, which is what should naturally happen in an economy. You should try to ensure that your citizens have a high birth rate, at least 2 children per family, so that your population doesn't decrease. At the very least, it stays stable, and you should promote population growth policies based on births. However, when you start promoting migration policies, this happens. Look at the imbalance in recent years. Here we see the effect of the pandemic where people didn't. There were very few births because women were afraid to get pregnant during the pandemic period. But you can see how the number of births has been completely disproportionate, systematically decreasing in the United States. But you can't have this issue of international migration. But what impact does Florida have in all of this? Let's look at it on the map. Here is the map showing how population growth has been affected in 2024, and I want to look at it from a comparative perspective. We can see New York. New York has a per capita growth in 2024 of 14 international immigrants for every 1,000 residents. However, when we look at Miami, we're seeing 33 international immigrants for every 1,000 residents. When we look at the Orlando area, let's zoom in a bit more on the map. In Orlando, we're seeing 22 for every 1,000 residents. When we look at other areas of the country, like in Texas, for example, we see 16 in Houston, or here's another spot, a pretty dark blue one, that's 22. But what I was getting at, Jenny, is that in Miami, Fort Lauderdale, it's 33 for every 10,000 residents. This could impact the rental sector if the number of people who are going to move or leave really starts to go down. Not necessarily leave the United States. But given President Trump's deportation policies and Governor DeSantis' deportation and pressure policies on undocumented immigrants in Florida, we can see that the movement or displacement is quite significant, and many housing units could end up vacant, and that's what we might see. In a way, this is actually benefiting the rental sector. Obviously, this doesn't affect the buying or selling sector, but rentals can definitely be impacted. This week's podcast is pretty long, Jenny. I'm not used to talking so much about Florida, but there's a lot of relevant information. We're signing off. How should we wrap up this podcast?
Look, we, the best real estate agents in the state of Florida, are here to serve you, to help you, to give you our best advice. Yesterday, we received a really nice message, which I forwarded to Gabriel from a client who told us, "Wow, I feel honored by the analysis you just did for us. We are the face of a team, a group of people who work and are here at your service to give you the best options. It might not be the information you're looking for, because people always want to buy in the best way, sell in the best way. But we're going to tell you the truth so you can wait and get ready, the truth so you can buy now. The important thing is that you have information you can trust, and we're here to provide it. Getting in touch with us is super easy. Below is the direct link to our WhatsApp, and we're here to help."
Thank you so much to everyone who watches us with those great words from Jenny. That's right. The best real estate agents in Florida are under, well, we're the visible face for them on YouTube, and at the end of the day, it's all about the numbers. Numbers that we study in detail so you don't make mistakes when buying, selling, or renting. Don't forget to give this video a thumbs up. By doing so, you let the platform know it's quality content that should be shared. Also, share it if you know someone who might be interested. And of course, subscribe. Subscribe to our channel for 4 podcasts a week with the best of US real estate, Florida, and of course, our financial podcast. Thank you so much once again. Where to Live in Miami podcast, a creation and production of Inviert and Miami Real Estate. Total transparency.
We have to give